Hello, today we're joined by Paul Marriage, the elite rated manager of the Tellworth UK Smaller Companies Fund. Hi Paul, thanks for joining us today.
Hi James, very good to be with you.
Paul, one of your colleagues said that the market has been prone to ignoring good news for UK smaller companies recently. Why is this and why do you think they've fallen out of favour?
The UK small caps is always a sector that you run from when wider global markets get tricky, and messy, and clearly we've seen plenty of that here. We started the year with a lot of people worried about the macro environment, and then clearly the Russia-Ukraine situation evolved, got messy in March. And in those kind of high risk, high volatility markets, do you go and buy a load of illiquid UK small caps? Not usually. So it is one of those times when small cap management teams and small cap fund managers, crack on with running their portfolios and their businesses to the best of their ability, but they don't get a lot of love and support from the rest of the market. But we've been doing this quite a long time, so we've gone through plenty of those periods.
And where are we in the M&A cycle? I mean, I think we've had quite a few deals the last couple of years. Things seem to have quietened down a bit so far this year. But do you see that picking up again? And do you think that can lead to a better period for UK small caps?
Yes, M&A is always a really interesting one for us because when M&A picks up, it's usually quite an interesting canary in the coal mine for valuations of the UK market, particularly UK small cap. So if you look at the times that M&A has picked up in kind of recent history, you'd see M&A picked up in summer 19, go back to summer 19 if we can remember that. We were very worried about the political situation in the UK. We didn't know what sort of government we would have. And there was a lot of uncertainty around Brexit and whether any settlement would be reached. M&A picked up in August that year. If we look at the post-pandemic period in the summer of 20, summer, autumn 20, similar kind of time, autumn, September, August, September, M&A picked up again. People were really worried about how COVID was going to play out, probably past the worst fears, but before confidence in vaccines. And M&A picked up again then. M&A picks up when external investors, so private money or trade investors, value companies more highly than public markets. So M&A picked up again last year as we went through into that kind of Omicron concern. And actually it's continued this year. I wouldn't say it's fallen away. I'd say it's been, interestingly, it's been a consistent theme even through the whole Ukraine situation. In fact, we had a bid for CareTech, UK specialist healthcare provider, which came in March from the founding family, still ongoing. We'll see how that plays out. We had a bid in January for Marshall Motors, December, January for Marshall Motors, UK car dealer. Interesting thing there was that an online car retailer, Cinch, needed the physical assets that a traditional car dealer has to deliver its growth plans. So quite interesting theme there that new economy, old economy actually can work together. So yeah, I think we'll see much more M&A. Other stuff we've seen, Spectris, Oxford Instruments merger announced. I think that was short term, really sort of killed off by the Ukraine crisis. But I wouldn't be surprised to see that sort of thing come back. So yeah, M&A's definitely here. M&A bankers are busy. What we've not seen, which is often sort of linked with M&A, is the IPO market, which is definitely closed still. I've heard rumblings of we might be looking to bring this. Do you want to meet it from investment bankers and brokers? But it's pretty quiet. We saw one interesting secondary placing last week. Marshall's, quite interesting. Marshall's is a building materials business. Top end of what we do, mid cap, but it makes pavements and that kind of stuff. Those kind of stones, landscaping, your new drive. And they purchased Marley, which was a roof tiles business that looked at floating last year, actually. So that was an interesting one because people knew Marley pretty well because they looked at Marley and then another public companies come to buy. So if you're an investor in Marshall's, those kind of devil deals where Marshall's are issuing equity for maybe even a company that's all interesting. That's usually quite an interesting transaction. I think that went down reasonably well with people. So yeah, M&A's here, and I think it's going to carry on. It's going to stay here, and we might even see it pick up. So that's a really good sign for small caps and UK market in general. That's a good. If you're looking for reasons to be cheerful about UK small cap and UK small cap outperformance and it becoming a sector you want to be involved in, then that's a really good sign.
So do you think now is the time for small caps? I mean, we've had a really strong run for small caps relative to larger peers, I think, over the last 10 years.
Yeah.
The last few months, obviously, things have cooled off. It's reversed. And, The large caps have really had their time in the sun, but small caps now looking much better value.
Yeah, I mean, for somebody whose entire career has been in small caps and is a founder of the small cap specialist fund manager, my answer is always buy UK small cap. But clearly, there's periods when small cap is in a better or worse place. Small cap was in a great place in Q4 20 through to kind of most of the first half of last year, as people came sort of back into market risk on, and that perception of value of domestic, which UK small cap is often tagged with, even though it is actually quite international, made it really popular. As people got worried about Omicron and things last year, it became less popular. We've talked about why it's been unpopular this year. It feels to me like it's one of those interesting times where if you keep meeting companies and picking stocks, is what we do. We've met 65 companies, I think, year to date, and we'll meet, a couple of 300 over the year. Most of these companies will meet a pretty front foot. They're relatively positive. They know where the dangers are. They know what the challenges are, delivering a growing order book with supply chain constraints, etc. But most of those people, you come out of those meetings feeling fairly confident in those equities. So if the stock market just wants a little bit more risk, then UK small cap in particular hasn't played the catch up since March. Small and mid caps have lagged large caps a bit. So in the very short time, I think there is an interesting catch up trade. Then we've got to listen to see what companies are saying about some of the bigger macro issues that have been around all of this year. And those that can navigate them are probably going to be pretty good investments this year. And that bubbling M&A that I referred to is nicely supportive in the background.
And of course, the hot topic at the moment is inflation, which is sort of reappearing for the first time in a long time. How are your companies dealing with that? I mean, can you give us a couple of examples, maybe, of some companies with strong pricing power?
Yeah, so you always talk about high quality businesses are the sort of businesses that can cope with this because they've got in demand products which have got enough value in them that they can pass on the price increases of their input costs, of their labour costs going up. I think one of the interesting things about the inflation situation, people forget the labour costs are going up. People are giving pay rises to staff. So the cycle is working in that element, in that the consumer is probably going to be earning more, even though everything's going to be costing more. So that's important to remember that. So the consumer's spending power might be reduced, but it's not simply binary. It's not just all costs are going up and my income's not going anywhere. My income's going up. So that's an important part of the dynamic to understand. And if you look in our portfolio, clearly the companies that have got the most rich IP, that are doing the most mission critical things for their customers, are the ones that can pass prices on. So, if we look at things like software companies, InStem, which is a software company supplying software into medical research, we need to keep discovering new drugs. We need to keep doing that efficiently, and the use of software is important. High value scientists are scarce. Their own costs are going up probably, so more software. That's an interesting place to be. InStem, mentioned that one. Judges Scientific would be another one. Judges Scientific makes a really broad range of scientific instruments for testing, for safety applications, for research and development. High value machines where small, modest price increases. The value of the metals, of the materials, semiconductors and stuff that go into those machines. Individually, those components might be quite high value, but this is a £10,000 or £20,000 machine, and the component value, they can absorb some of those cost increases, pass a bit onto the price, and still maintain and deliver a strong order book. So, absolutely, it is about picking the stocks with the most pricing power, but at the right valuations. And that's quite interesting that some of those valuations, particularly in the growthier stocks, come down a lot this year. And we've topped up our holdings for some of those things that have been a lot weaker, where we think they've got the strongest pricing power. I think the challenge we've seen for a lot of companies is great products, reasonable pricing power, strong order books. Can they physically deliver the order book? Can they manufacture enough stuff to deliver to their clients? Have they got the labour, and have they got the componentry? And that's a real challenge for companies. And I think companies are working really hard, having to run very hard to deliver. And in the scheme of all the bad things that can go wrong with companies, a growing order book that you're struggling to deliver is probably not the worst scenario. It's not ideal for short-term profits. But if that order book is still growing, people still want your product, eventually you'll work through the supply chain issues and the shortages and deliver to those clients.
Better to have too much demand than too little.
Yeah, exactly, yeah.
Well, that's been a really interesting insight, Paul. Thank you very much for that today.
Oh, it's all. Thanks for your time and thanks for your interest, James.
And if you'd like to learn more about the Tellworth UK Smaller Companies Fund, please visit fundcalibre.com.